Your brain is programmed to make you lose in trading. Our brains were formed millions of years ago in the African savannas to survive there. Their goal was survival against danger and secure food. Operating on fight or flight instincts, now we bring that same brain into trading, and those instincts can sabotage us with panic or risky choices. Think about it. Back then, a split-second decision could mean escaping a predator or securing a meal for your tribe. That wiring made sense for survival, but in today's complex markets, it's like bringing a spear to a chess game. Your brain pushes you to react impulsively, buying on a whim or selling in a panic, when trading demands patience, strategy, and discipline. Today, we will uncover why your cave brain fights you and how to outsmart it to trade like a professional trader. Psychologists Daniel Kahneman and others identified traits that hurt us in trading but helped in caveman days. Here are 4 big ones. These traits are hardwired from thousands of generations surviving harsh environments, and these studies showed how our brains prioritize short-term survival over long-term logic, a concept called behavioral economics. In trading, this mismatch leads to costly mistakes. Let's break down these 4 instincts and see why they trip us up in the markets. First, fear of losing. Our brain wants certainty because losing feels like getting eaten by a saber-toothed tiger, and back then certainty meant staying alive. But in trading, we need to accept uncertainty. Taking losses is crucial. We need to focus on the odds and adapt a probabilistic mindset by having trust in our edge. Imagine you are in a trade and that's going against you. Your gut screams to hold on, hoping it will bounce back, because admitting a loss feels like failure. But successful traders know cutting losses early is a strength, not a defeat. Studies show losses feel twice as painful as gains feel good. Kahneman called this loss aversion. To overcome it, you need a system like setting a stop loss at a fixed percentage of your total account balance. For example, 1 to 2% to take emotions out of the equation. Trusting your edge means believing in your strategy's long-term odds, not each trade's outcome. Second, overconfidence. Back in the day, overconfidence helped our ancestors hunt big animals or lead tribes through tough times, making sure they stayed alive. But in trading, it's a disaster. Thinking you are smarter than the markets make you ignore risks, overtrade, and pile up losses from fees or bad bets. Overconfident traders often double down on losing positions, convinced they will outsmart the market, only to watch their accounts shrink. Third is herd behavior. We are wired to follow the crowd, chasing hot stocks because we are scared of missing out, FOMO, that leads to buying high and selling low. In fact, 90% of retail traders lose money, probably because they copy hyped up trends. They dive into stocks like crypto without doing their homework, then get burned when the hype dies. Imagine seeing a crypto coin all over social media, everyone saying it's going to the moon. Your brain wants to join the crowd, like following a tribe for safety. But markets don't care about tribes. A 2020 eToro study found traders chasing social media hype lost 15% more than those who didn't. Finally, seeking instant gratification. In caveman days, grabbing quick rewards like food or shelter kept our ancestors alive. But in trading, chasing fast profits leads to impulsive moves like buying on a spike or selling too soon. Patient, long-term strategies win, not quick hits. Think of a trader who buys a stock because it's up 10% in a day, expecting it to keep climbing. When it dips, they panic sell, missing a bigger rebound. Data from Vanguard shows swing traders who hold positions over days or weeks or even months outperform day traders in the long term. To fight this urge, follow your trading plan and don't take trades unless it aligns with your strategy. This rewires your brain for discipline over instant wins. Your brain may want to trick you, but these 4 strategies will help you trade smarter. These aren't just tips, they are tools to rewire your instincts for the modern market. By mastering them, you will align your decisions with logic, not emotion, and you will join the small percentage of traders who consistently win. Let's dive into how you can take control. First, create a trading plan. Set clear rules for buying and selling and risk limits. This stops your emotions from taking over. A good plan defines your entry price, exit strategy, and how much you are willing to risk. Say 1% of your portfolio per trade. Risking 1% means only a small slice of your capital is on the line for any single trade. For example, with a $100,000 portfolio, that's $1,000 max at risk per trade. This keeps losses small, so one bad trade doesn't wipe you out. Consistency is key. Stick to that 1% risk across every trade, no matter how confident you may feel. As you get more experienced, you might bump it up maybe to 2 to 4%, but only when you have proven you can handle the markets with discipline. Second, stay calm. Your brain sees trading risks as life or death threats, triggering panic. Practice deep breathing or a quick pause before trades to stay clear-headed and make rational choices. When your heart races as a trade goes against you, that's your cave brain in overdrive. A simple habit you can do before any trade is pause. Take 10 deep breaths and check your trading plan. This simple habit cuts impulsive trades by half. Third, don't put all your eggs in one basket. Diversify your trades across non-correlated assets like stocks, forex, and commodities. A single bad trade won't ruin you. Picture your portfolio like a balanced meal: stocks, bonds, forex, maybe commodities. Trading across various asset classes builds a stronger, more resilient portfolio. It's not thrilling, but it's your safety net in volatile markets, protecting you from big losses and helping you recover faster when the markets shift. Lastly, don't let limiting beliefs stop you from trading. Many traders think losses mean they have failed. They must predict every market move. They are not smart enough after bad trades, or they are undercapitalized, or they need to trade perfectly to succeed. Try viewing losses as lessons to build confidence. See a small account as a chance to master risk management and to recognize that perfection isn't required. Progress is. Write down fears or talk to a mentor to guide you and trade better. This shift is key. When you keep journaling the feelings you feel when you trade, you will better understand your limiting beliefs over time. In 6 months, with consistent effort, you can make calmer choices, improve your skills, and boost profits in the long term. So there was this famous successful entrepreneur who made millions of dollars in different business avenues, but came to trading thinking it was like any other business. He failed big time, losing millions of dollars trading. He treated trades like deals he could control. His ego could not handle accepting losses, but with a mentor's guidance, Using a rule-based system, risking only 2% per trade, he was able to gain consistent profits in the markets within a year. His lesson was, let go of control and trust the system. Trading is a battle against your cave brain, formed millions of years ago in the African savannas. Watch out for fear of losing, overconfidence, herd behavior, and instant gratification. Fight back with a solid plan, calm focus, diversification, and a new mindset. You will trade like the top 2 to 3% in no time. This isn't just about money, it's about mastering yourself. Start small, test your strategy on a demo account, and build confidence. The market rewards discipline, not instincts. Join the elite traders by outsmarting your brain. That was the end, guys. If you learned something, make sure to subscribe to get more videos like this. See you next time, guys.